Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 251 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, Nick Whitaker is back on the show, filling in for Matt. Nick, I'm almost going to offer you this spot every single week since Matt hasn't been on too much this year. But as always, welcome back and thanks for doing this.
Yeah, it's nice to have a bench. You know, gotta have some subs. The sixth man has to come in occasionally. Very important. I've been watching a lot of basketball, so that's where my head's at.
Yes, and I love you, Matt. Yeah, I know you're busy, but I miss you. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts and as of the market close on May 8th. S&P 500 index up 3% for a month and up 8.8% for the year. The Dow Jones Industrial Average up 3.3% for the month and up 3.6% for the year. The NASDAQ Composite Index up 4.1% for the month and 8.6% for the year. The Russell 2000 Small Cap Index up 4% for the month and 1.5% for the year. And the Vanguard All World ex-United States ETF up 2.9% for the month and up 4.8% for the year. 3-month Treasury rate at 5.45%, the 2-year Treasury rate at 4.84%, and the 10-year Treasury rate at 4.48%. Big headlines, current events from the past week. Big earnings report from Google last week, Nick. So Google announced a dividend of 20 cents per share for the first time in its history during the earnings call 2 weeks ago. And they also announced a $70 billion share buyback. So for those who don't know, share buyback, taking shares out of the open market, theoretically increasing the earnings per share, theoretically increasing the price per share. The financials of the company do not change, but this is typically what we see as companies continue to mature and want to provide more value to shareholders, Nick. So I think it's going to be interesting because Google's been this hyper growth company for really since its existence, right? And now we're starting to see this maturity where they're starting to return money to shareholders, which I'm sure long-term shareholders of Google are thrilled to see. So it's just interesting. You know, we're seeing right in front of our own eyes these, you know, big tech companies kind of going from this growth phase to this value-oriented mature phase. And we've seen it in the past too, right? IBM didn't work out too well for IBM. I hope it's a different story with Google, but definitely something that was catching headlines during earnings season for this quarter.
Yeah, it's definitely a landmark moment for Google and for investors. I'll just add one more thing about the buyback for listeners who aren't aware of, you know, why would a company do that? A lot of it gets down to maximizing shareholder value and investors saying, hey, you have a bunch of cash on the sidelines. What are you doing with that cash? There's no reason to just hoard the cash. And so if a company, doesn't see a great way to use their cash, maybe an acquisition or putting it into another
research and development.
This is another great option where they can say, okay, we'll take some of our cash, we'll do a share buyback, we'll increase our shareholder value, and so shareholders tend to like this quite a bit.
Yeah, exactly. And we've seen this from Apple over the past several years. They buy back a crazy amount of shares each year, and it's because their cash hoard is bigger than the GDP of a lot of countries, right?
Yeah.
So it is something to do to reward shareholders. Only other thing I had, Nick, was the jobs report for April. So the U.S. economy added fewer jobs than expected in April, and the unemployment rate saw a slight increase, indicating a cooling labor market. And you might be listening to this thinking that that's a negative for the economy and the market, but the market actually reacted pretty positively to this news, as a cooling job market should, in theory, help with inflation, right? Why has inflation been stubbornly high or stuck around for so long? It's because Americans continue to spend and we continue to consume. And if people are getting raises and, the job market is really tight, then inflation's going to stay high. So it's unfortunately one of those double-edged swords. Is you never want to see people lose their jobs and have have unemployment go up. But one way to bring that inflation down is people not spending as much.
Yeah,
and if people aren't making as much, in theory, they're not going to spend as much, right? Yeah. So I think this is definitely one of the goals of the Federal Reserve, as crazy as that sounds. But that's why I think you saw a pop last week once this jobs report for April came out.
Yep, absolutely.
Moving on to tweets, articles, and research from this week. The first thing I had was a tweet from Charlie Bilello on April 30th. And he says, incredible. Amazon's AWS revenue over the past 12 months, which has been $94 billion, was higher than the revenue of 466 companies in the S&P 500. I mean, just take that in for a second. Just a segment of Amazon's business, that revenue was greater than most of the companies in the S&P 500. That's outstanding.
Yeah.
So AWS, obviously their cloud solution. I just thought this was really interesting. I wanted to point out just how powerful some of these large companies are. The likes of Amazon and Apple and Microsoft and Google specifically, just segments of their business produce more revenue than a lot of companies that are publicly traded. So it just goes to show you the sheer size and importance that these companies and stocks are to the overall market. So nothing really else I wanted to add there. I just thought it was an interesting stat. It's just crazy that, there's a company out there that one segment of their business generates $94 billion in revenue over a 12-month period.
And it's not even the segment of the business that's visible really to the consumer.
Exactly.
Right? That's not what the consumer associates with Amazon. Completely different business segment.
No, everyone's like, it's a retail name,
has
right?
Nothing to do with the trucks you see on the road.
Right.
But is actually one of their most important segments from a growth perspective, and why investors, over the past 5 years have been increasingly bullish is because of the growth rates in AWS. And there's future... there's more run room in the cloud segment for sure.
For sure. Yeah, it's going to just keep growing and expanding. Again, just to clarify, this is not a recommendation for or against Amazon. Just thought that was an interesting stat. Yeah. Next thing I had was a article from the Wall Street Journal from Nicole Friedman titled "The Hidden Costs of Home Ownership Are Skyrocketing." So, I've seen recently more and more, Nick, this big debate in our industry about should you be buying a home or should you be renting a home? And we've talked about this before and how it's, you're usually on one side or the other. But I think Nicole did a pretty good job of showing how it's not just home prices skyrocketing. It's not just mortgages at 7%. It's everything else that comes with a home. So just want to go through this list here a little bit. There was some commentary from kitsis.com. So they said, when individuals think about the affordability of home ownership, they are likely to first consider the potential mortgage payment, which is a function of both the price of the home and the interest rate they can get on the loan. In the past couple of years, both of these components have been rising, creating significant affordability challenges for those looking to purchase a home, particularly first-time homebuyers who do not have the benefit of having proceeds from a sale of a current home to support the purchase. Rising home prices and broader inflation not only have impacted the affordability of buying a home, but also the property taxes homeowners pay. And at a time where local budgets and at a time when local budgets are rising amid inflationary pressures, the property tax bills have risen as well to support these outlays, with the average property tax on single-family homes in the U.S. rising to $4,062 in 2023, which is up 4.1% from 2022. Now, I don't know about you, Nick. I know you are a homeowner, but I can definitely attest that, yes, my property taxes have skyrocketed over the past couple of years.
Yeah.
They also say home insurance costs have been rising as well, with a 20% surge between 2021 and 2023, according to insurance shopping site Insurify. And I'm sure that number is a lot higher on the coast in places like Florida and in California. According to home improvement tech company Thumbtack, the average cost to maintain a home, for example, expenses like gutter cleaning and roof repair, rose 8.3% in the fourth quarter of 2023 compared to the year prior. The key point is that while many homeowners focus on the cost of their mortgage, many might be surprised to see that the hidden costs of home ownership are also rising significantly. So again, it's not just looking at the price of a home and seeing if you can afford the mortgage payment, Nick. You have to think of all these other upkeep costs that go into it, which have also risen over the past several years. So my point being is now more than ever, it might make sense to rent until the housing market cools down or inflation settles out or you get a higher paying job. You know, you just have to take all of those things into consideration before you make the decision if you want to buy or rent. I know that people are like, well, I'm just throwing money away if I'm renting. I'm not building equity in anything. But hey, this is the environment we're in right now. So there's a lot of people out there that financially it makes sense for them to rent, and there's no shame in that, right?
No, not at all.
So I just thought it was interesting. It's something that I find a lot of people not thinking about when they're making home purchases.
Yeah, it's an excellent point. And if you're a homeowner or you're thinking about buying a home, that needs to be a line in your budget is maintenance, and you can find different estimates. I've seen estimates as high as 5% of the value of your home, to 3 to 5%, somewhere in there. But I think if you put 5% of the value of your home as an as an estimate for your maintenance costs for the year, that can give you a better understanding of some of those costs that can rack up pretty quickly. It can happen. Like since I've been in my house the past 3 years, I had to replace the water heater. I know you had to do the same.
Yep.
I think the air conditioner is going to go out here probably in the next year or two. So things of that nature that you don't plan for. And the other thing I'll say about that, because I was maybe like 5-6 years ago, I was kind of in that slightly different housing environment, of course, 6 years ago, but a lot of it gets down to time when we're talking about renting versus buying and how long you're going to be in a city, or if you know you're going to move, or if you think you're going to move in the next 5 years, then the renting is most likely the best case scenario for you right now because of the housing market and interest rate environment. A lot of it does get down to that. If you know you're going to be in a city for 20 years and that's your home and you don't want to move and you're hell bent on staying there, then I would say study your budget really well. Make sure you have some of those housing costs that we just talked about in there, and then that will help you make a better decision. But time is a massive piece of it for young people who are, maybe let's say late 20s, early 30s, and they don't know if they're going to stay in the city. Maybe they're living on the other side of the country from their family, and someday they want to move back. It might make more sense to continue to rent. So that's a big piece of it.
Yeah, for sure. And more recent example for me, I think every week over the past month, I've had the HVAC company that services our HVAC system in our house. They've been at my house every week for the past month because the AC on Mia's side of the house went out.
Yeah.
And the week before that, or a couple days before that happened, they were out just doing routine maintenance and everything was working perfectly. And 2 days later, the AC went out, so they came back. Yeah. Then they had to replace the motor. So that was another trip. And then they were just back earlier this week to clean the coils because they were dirty and seemed like they haven't been done in years. Yeah. So it was nuts, right? But those are just things that you don't think about when you're looking at a house, right? Yeah. Really good article there. Last thing I had was an article titled "Turn on this new iPhone setting to protect your money and photos" from Nicole Nagoyan and Joanna Stern at the Wall Street Journal, also with commentary from kitses.com. So also a little bit of a different article than what we usually talk about on this show, Nick, but I thought that this might be good for some people to hear if they tend to lose their phone a lot, like my wife does. Fortunately, it's usually just in the house, but they say smartphones have made life in the 21st century much more convenient, as they can include everything from a mobile wallet to a photo album to a primary source of communication. A downside of this convenience, however, is that if someone were to gain access to the smartphone, they could potentially make unauthorized charges or even drain the owner's bank account. Apple earlier this year introduced a feature called stolen device protection that makes it more difficult for unauthorized users to access key data and tools on the device. The setting restricts what an individual can do with just the device's passcode when it's away from a, quote, significant location familiar to the iPhone. For example, one's home or work, requiring one of the biometric IDs to be scanned, then instituting a 1-hour delay, and then requiring another biometric scan before implementing more sensitive changes. To turn on the stolen device protection feature, first go to Settings, then Face ID and Passcode. Type in your passcode, then scroll down to the stolen device protection and turn it on. Users must have two-factor authentication on the Find My feature enabled for their Apple ID to use stolen device protection. Next, to add the significant locations feature, go to Settings, then Privacy and Security, then Location Services. Scroll down to System Services, then Significant Locations. The iPhone will not tell you which locations it has determined to be, quote, significant, but this is done so that a thief cannot just go to that location to override the extra layer of security. So I think this is good, Nick. You know, we're in the day of age where everything in our lives is on our phone. It's now, you know, kind of our own wallet as well. And, you know, if you lose your phone and you lose your wallet, you're like SOL, right? And it makes life really harder, a lot more complex. So
it'll be a new kind of freedom.
Yeah. So I think this is great. So if you are not aware of this and, you know, you want that extra layer of security, especially because a lot of us do our banking online now and a lot of us do investing online now. So this is really good, especially if you're handling money via your phone. Definitely something that I would recommend.
Yeah, absolutely. I think the more knowledge every one of us can have about our data and the sensitivities around our data is for the best. Europe's probably 5 years ahead of the United States as far as data protection and GDPR and everything. So it's coming. As far as, you know, just how much data, you'd be shocked just how much data with your cookies and advertising and everything that people can pull off your devices. I shouldn't say people, that companies can pull off your devices, and it's good to be aware of that kind of stuff. And this falls into that category for me of, you know, protect yourself.
Yeah, exactly. And I'm sure Android has a similar feature or is going to roll out a similar feature. I don't know that world. So.
Yeah, I don't have an Android phone either. So sorry, all you Android listeners.
Yeah, my dad's one of those. Yeah. The only guy in the family texts with a green bubble.
Yeah, the green bubble. What you gonna do? I have a couple things for us today, primarily earnings focus. So the first two are pretty quick here, but tweet from the 6th of May from Lisa Abramowitz over at Bloomberg. She said for Q1 2024, the blended earnings growth rate for the S&P 500 is 5%. If 5% is the actual growth rate for the quarter, it will mark the highest year-over-year earnings growth rate reported by the index since Q2 of 2022. That's via FactSet data, and from Mizuho's Charlie Retsky is who she quoted that from, who he's on the sell side for Mizuho, so he's an investment researcher, essentially. So what the blended earnings growth rate is, and I explained that, I believe, last time I was on the podcast, but it's basically taking everyone who has reported thus far in the cycle and in the earnings cycle, as well as those who have not reported, and using those estimates to get the whole picture. So that's what the blended growth rate is. But we're largely through the earnings cycle. I would say, 60, 70% through. So yeah, 5% is where we're at, which is pretty good.
Yeah, that's great. And just as a reminder, earnings are what drive stock prices, right? So whether you are a fundamental investor or analyst and you're looking at balance sheets and income statements and margins and all that good stuff, or if you're more of a technical trend follower, that's going to show up in the price chart, right? Companies growing their earnings and growing their revenues, most of the time they're going to be doing pretty well if they're doing it consistently. So, excuse me, this is something that we definitely want to see in a bull market, is earnings accelerating, which it is. So very, very good news. Obviously the fastest growth in 2 years to the quarter. So.
Rolling right into my next one is earnings forecast through the end of the year. This is a tweet from yesterday from Bruce Zaro. He's a managing director at Granite Wealth Management. He says the following: earnings forecasts for the second half remain pretty optimistic according to FactSet/NASDAQ research. Do you agree? And he shows the small, this is specifically for the S&P 400 and the S&P 600. So a little bit of a different lens. This chart will show you the mid caps and the small caps. So the smaller companies.
So not your Amazon and Apples of the world.
Exactly. A lot of the smaller companies that you don't see the headlines about. Right. And so it shows you the kind of the current growth rates year over year and what the forecast is. And that's very optimistic from a forecast point of view. The way you want the economy to move and fluctuate in a bull market, you want the smaller companies to start to take off. That's typically when you're at the beginning of a new cycle in the market. So seeing this kind of forecast among smaller companies, that's excellent. That's what we want to see as investors and as bulls.
Yeah.
Right?
And this chart kind of embodies what I just said, right? So, look at the earnings growth was negative for mid caps and small caps for, most of 2022 and 2023.
Yep.
And look how mid and small caps did compared to large caps
over that time
last
period.
year. They've sucked, right?
Yeah, they were very bad.
It's been very bad. And now you're seeing the forecast for later this year. And what are you seeing? Small caps bottomed in October with the broader market, and small caps have been as strong as they've been over the past 2 to 3 years. And look at what the forecasts are. It's because they're projecting to earn more money over the next couple of years, right? In the next couple of quarters. So, again, this is something that makes sense to me, and it's the market being smarter than all of us and sniffing out that return to growth.
Yep, absolutely.
Prior to these companies actually reporting their financial results.
Yeah, absolutely. So we'll throw that chart up there for listeners. It's a good looking chart too. Did a nice job with his annotations. Thank you, Bruce. The last piece I have is related to earnings in a bit of a different way. It's about non-profitable tech performance. So this is a tweet from Kevin Gordon. He's a senior investment strategist over at Charles Schwab. It's actually a tweet from yesterday. He says the following: 5-year return for non-profitable tech plus 29.1%, for the S&P 500 plus 80%, And then he has a little disclaimer here that says past performance is no guarantee of future results. And then he has this chart here that shows that. And we talk about this a lot and internally about, we like companies who are profitable and are growing earnings and are growing their revenues and have nice clean balance sheets. That's generally speaking what we like. And you can see this swing in this chart where there's non-profitable tech. And what we mean by non-profitable tech, we mean typically they're going to be smaller companies and a lot of software companies that aren't actually making money yet. Their income is still negative because they've taken on so much debt and they're still trying to grow and scale their business, essentially. And you can see that swing in 2020, post-COVID, and then you can see it kind of come back. And I brought this up for two reasons. One, with higher beta, more volatile names, in areas of the market, such as non-profitable tech, your small cap tech, who their earnings are negative still, there's going to be more volatility. So you can expect these massive swings. And that's not to say that this group's not going to swing higher in the next year, but the volatility is going to be massive. We've talked about it with Apple. When you look at Apple's stock price, 20 years ago, the swings were incredible. And if you look at the percentage on that, it's absolutely incredible. So something to keep in mind when you're looking at individual investments and particularly some of these tech names that your buddies might tell you about. If their bottom line is negative, they're going to be volatile. The market needs to see that continued growth, which is why come earnings period, when a non-profitable tech company comes out and says, well, you know what, we said we were going to grow at 20% next quarter. It's actually going to be 10. That stock drops like gangbusters. I mean, it's 10, 15, 20% of a correction. Yeah. So I just kind of wanted to show that chart and just give that a little bit of perspective to listeners.
And look, this is a great chart. If you are one of those investors that is a little bit more active and not just buying an S&P 500 fund, look, there were ways to get involved in these non-profitable tech companies in 2020, because if you look at this line, like, it's pretty much straight vertical. So I don't know anyone that wouldn't want to be involved in those companies looking back on it, right? But this is
2020 hindsight, yeah.
Right? But if you're a technical trader or a technical investor and, your system or your process is, you look at companies that are making new 3-month highs or new all-time highs, you would have caught a lot of this trend. But the other side of it is you have to have a process to get out, right? And not ride this all the way back down.
100%.
So again, different strokes for different folks. At one point, people were probably kicking themselves for not owning Zoom and Pinterest and all these other software companies that went nuts after COVID. But on the same side of it, once they all had their fall from grace in 2021 and 2022, they were probably like, oh, thank God that I didn't get involved with it. So there's a lot of different ways to look at it. But just be prepared to deal with some volatility if you're going to invest in companies that aren't making money yet.
Right.
However, there are opportunities in that, right?
Massive
Facebook didn't make money
opportunities
several years ago, and now look where Facebook is. Same thing with Netflix and all these other big companies that we have today.
100%.
There's opportunities, but there's also instances where companies like that have gone to zero. Yeah. So it's about sizing the position properly and making sure that you're taking the proper amount of risk for your goals and objectives.
Yeah, and be patient, with these, you're going to see the swings like this. So just because it's, now it's back down over the past 4 years, that doesn't mean that these companies aren't going to be successful companies that could be multi-billion-dollar companies someday. It's just, it takes time, and you're going to see these massive swings where, 2020 was a little bit of a wild moment there, which is why this chart is so drastic. But generally speaking, it's very normal to see that kind of volatility. And if anyone really is curious, go back and look at Apple, and don't just look at Apple on a big chart, but kind of zoom it into like the first 5 years of public trading and see what the peak to trough percentage change was, and then back down, the drawdown, see how big those, 80% swings, right? So patience is a virtue when we're talking about this space, non-profitable tech, and it doesn't have to be tech, non-profitable companies, right?
In general.
I do want to acknowledge the amazing pun that we just had, which was 2020 hindsight. And we're talking about 2020.
We are talking about 2020. I love that. Thank you for pointing that out.
That was a truly no pun intended moment.
Well, moving on to our financial planning topic of the week. This was an article from Andrew Sarna on his Substack blog, Off the Charts. And this was back on April 26th. And in this, he had a chart, Nick, about how much money millennials and Gen Xers are set to inherit over the next, let's call it 20 years, right? Yeah. And these are going to be, if this plays out, some of the largest inheritances in history over the next 20, 30 years. And the reason I bring this up is that if you haven't already had the inheritance conversation with your kids, now might be a good time to do it. Also, if you don't have an estate plan or haven't updated yours in a while, it may be a good time to do that. It's just my personal opinion from being in the industry for several years that the majority of people receiving large inheritances won't know what to do with it other than spend it. So this article kind of made me reflect and go back on my opinions on why estate planning is so important and why having the conversations with your adult kids is so important. So the first thing I wanted to mention is preservation of wealth. So, effective estate planning helps in minimizing taxes and other expenses, ensuring that a large portion of one's assets can be transferred to the next generation. We all want to pay as little in taxes as possible, so let's put a plan together to achieve this. The federal estate tax is a tax on the transfer of property and wealth after someone dies. Essentially, if the value of a person's estate exceeds $13.61 million in 2024, a part of it may be subject to this tax before the remaining assets are passed on to the heirs. Now, you may be listening to this and saying, this won't apply to me. However, as it stands today, Nick, if Congress does not act, starting in 2025, the federal estate tax will be dropping back down to people whose estate is worth $5 million or more, okay? Number 2 is avoiding probate. By setting up proper estate planning structures like trust and listing beneficiaries directly on your accounts, you can help your heirs avoid the often lengthy and costly process of probate, which can also be public and might disclose personal financial information to the public. Number 3 is conflict reduction. Clear instructions on the distribution of assets can reduce potential conflicts among heirs. This clarity can help maintain harmony within a family and ensure that your wishes are carried out as intended. I do not recommend leaving everything to one child and taking the approach that they will, quote, figure it out and share with their siblings. I've seen this several times before, Nick, and I can't think of a time when this is successful, especially when you're leaving a retirement account to a child. And let's say you have 3 kids. If you only leave it to the oldest, there's going to be crazy tax consequences to that kid when he tries to move money to the other siblings, right? Yeah. So it really is a horrible thing altogether.
And then he'll have to explain to his other siblings that, hey, I have this crazy tax bill, and
you got to help me pay this tax bill. Yeah, and it's horrible, yeah. Right? Next is asset control and management. So educating the next generation on wealth management and estate planning principles can help in sustaining family wealth over multiple generations. This includes teaching them how to responsibly manage and invest their inheritance. So if family wealth, family legacy is important to you, then the next generation needs to know how to take care of this money. So it's all about education because, as we've talked about before, a lot of this stuff is not taught in school, and you have someone that inherits $5 million. They've never taken a real finance class before or personal financial planning class before. what do you think they're going to do? Right?
Yeah.
That money's going to be gone.
They're not going to spend it well. They're
No.
not going to, which is the concern. Yeah.
Next is protection of beneficiaries. So a lot of people don't know that, estate planning can provide for minor children or family members with special needs, ensuring that they are taken care of financially in the way that you specify. There are also vehicles that you can set up that are creditor protected, meaning a creditor could not go after the assets listed in a specific trust. And an example of this, Nick, is if your child were to be sued for something, if they got in a car accident or caused a car accident, for example, or if they got divorced, right? Last but not least is business continuity. So for family-owned businesses, estate planning is extremely crucial in outlining succession plans, which helps ensure smooth transitions and continued operations. Without this, family business transactions are a disaster. And those are my own words. It is a disaster. We've had experience with this before. Even if it is a father transitioning a business to a son, and there's no legal documentation of how that transition is going to work, how the payment is going to work, it gets very messy very quickly, right? So even though you think it's going to be okay and both parties are going to understand where the other is coming from, you got to have that stuff papered, because if it's not, it's just going to cause animosity between family members, and it's going to cause money problems, and we don't want that.
Everyone needs to see the clear picture and understand all the numbers.
Right.
It's very important.
Yeah, exactly. So those are just a couple of things that I wanted to talk about. I think we've discussed estate planning on the financial planning topic of the week several times over the past year, but it's just because of the very high importance of it. And especially with the federal estate tax sunsetting at the end of this year and potentially going back down to $5 million, that brings in a lot more people that would never have been subject to federal estate taxes.
A lot more.
So it's known as the death tax, right?
Yep.
So if you have an estate that's worth more than $13.61 million in 2024, you're going to get taxed on a good chunk of that.
And it has potential to bring in even more for people who aren't there yet, but maybe you have 20 more years in the market. You could get there, that's it's going to capture a lot more people.
And it's not just investments, right?
Realizes.
It's all of your money, your investments, your houses, your cars, your other pieces of property. Maybe you have a farm, maybe you have a couple of businesses. It's all that, right? So really, really important to think about, especially going into next year. Lastly, if anyone wanted to create your own podcast, please use the promo code Jessup Wealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month free with promo code Jessup Wealth, all lowercase and no spaces. Before we leave it off, Nick, anything else that you would like to share with listeners?
No, not at all right now. Hope everyone enjoyed it. Enjoy NBA basketball if you're watching it, or hockey if you're a hockey fan. It's a very fun time of year.
It is. Weather's getting nicer.
The weather's warm.
Yeah.
We're golfing.
Yeah, it's great.
NBA's on. It's a good time.
What could be better?
Good time to be alive.
Well, thanks everyone for listening to episode number 251 of the Independent Advisors podcast. We will be back with you next week for episode number 252.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have have questions or topics you want to discuss on the show, message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.